Tesla released their Q2 earnings last week, and although I don't put too much weight into the quarter-to-quarter movements of a company, there are some developments that have grabbed my attention, both good and bad. Financially speaking, there was improvement in some line items and degradation in others. Total revenue from autos is still down 7% year over year, but Tesla's energy storage business is crushing it with a 100% increase over the same period. And there was also 21% growth in service revenue. Overall, total revenue, gross profit, and gross margins were relatively flat. But combine the high cost of goods sold with an increase in operating expenses due to AI development, and you get substantially lower profits. Tesla's profitability is down 45% year over year. If this was any non-growth, non-tech company, that big of a hit to profitability would probably be concerning. But the reason it isn't necessarily surprising is Tesla set the expectation for this type of performance all the way back to the start of the year. They gave investors guidance for a slowdown in their core business of selling EVs. So, if revenue flatlines and the company continues to ramp up investment in other business opportunities, yeah, profits are going to be squeezed. The slowdown is manifesting in two interrelated ways here: reduced vehicle prices and decreasing vehicle deliveries. The pricing is the result of new financing incentives, competitors' prices, and a general decline in EV demand. The latter two have impacted Tesla demand so much that lower prices have not been enough to keep sales numbers increasing. This can be seen in their operations summary, where total production is down 14% and total deliveries is down 5% year over year. But as a quick side note, there is a silver lining here, in that outside of the core business, Tesla's other revenue sources are showing record numbers. For instance, total energy storage exploded 158%, and music to my ears, the supercharger network continues to grow. The non-automotive segments of Tesla's business are maintaining a level of profitability and growth that, quite frankly, has saved the company from facing more scrutiny for the EV slowdown. The non-automotive revenue has essentially supplemented the losses in the auto business and is buying them time to make it through whatever this dip in EV market is. Now, a big part of the pitch to investors when looking at Tesla's growth potential is the technology they're developing in parallel to their core EV business. Artificial intelligence, self-driving, batteries, and robotics. FSD still has an uphill battle with regulators and customer adoption, but usage has grown significantly over the last few years. And Tesla's investment in AI is largely in support of making FSD as safely autonomous as possible. In addition, the company continues to work towards more efficient batteries and improving the economics of producing them. Also, a little nugget here, Optimus is working in one of the facilities as a battery handler. I guess we'll see how that impacts more of the manufacturing in the future, but decent start. And speaking of robotics, robotaxi. Because Tesla didn't offer a concrete timeline on robotaxi, I won't spend too much time in this video talking about it, other than saying this. I think most people's expectations on when that can be rolled out at scale need to be dialed back a few notches. If Tesla has hit a few walls with FSD in their consumer vehicles, with an active driver, mind you, think about the logistical hurdles up ahead to have a fleet of fully autonomous vehicles. Robotaxi is not happening over a quarter's time. And I'm also not going to touch on Elon's increasingly political stances right now. There's a lot going on there. No doubt his opinions have an impact on Tesla's perceived branding. Some people like it, some people hate it. I just don't want it to take away from talking about the company and their core business. So overall, I think this report was in line with general expectations. The slowdown in the EV market is crystal clear. The effects of Tesla's price wars against competitors are showing in the numbers. But then you have these other avenues of business that are not only profitable, but also showing meaningful growth. From my point of view, there's some short-term concerns, but nothing big enough to change my long-term outlook on the company. Trying to predict the future is pretty much impossible when it comes to the world of stocks, but it's fun to throw a guesstimate out there and see if I'm right. So what do I think is next for Tesla over the next few months? Will they come out of this slump? I don't think so. It was recently reported that although Tesla's sales dropped about 6% nationally in Q2, in California, probably the largest domestic market for them, sales nosedived 24%. And in the world's biggest EV market, competitors like BYD continue to ramp up low-cost alternatives. There's always going to be the friction of adoption, getting people to transition from gas-powered vehicles to electric. But that's a battle with a long time horizon. The short-term performance issues at Tesla, as seen in both the US and international markets, has more to do with affordability and the auto industry entering correction territory. We are still in a period of elevated prices and high interest rates. Purchasing any vehicle right now introduces unwanted financial strain for most households. And with the job market starting to show some cracks, not everyone feels secure enough to go out and buy a car. Now, why could this be affecting EVs more than ICE vehicles? Well, if you already don't want to spend the money on a car, what else are you going to focus on in your decision? Owning an EV is logistically more difficult with charging. They depreciate at a ridiculous rate. And although rare, a major repair completely negates the gas savings. Could interest rates being cut in September re-stimulate the demand for Tesla? Maybe. But it's a matter of how fast a rate cut makes its way through the economy. I just don't see it turning around in 3 months. The financial strain on households will continue to be felt more than likely into the end of the year. Before closing this one out, I did want to reiterate something. It may seem like these videos I do on Tesla are all negative or super nitpicky, and at the end of them, I always say I'm still holding on to the stock. But that's the point, y'all. When you own individual stock positions, it's absolutely crucial that you monitor your investments with a very critical magnifying glass. Can you be objective? Only then can you really determine if the company's long-term prospects can withstand any short-term volatility. And thus far, that's always been my conclusion. The problems Tesla is facing now will not be the problems they face into the future. I'm pessimistic over the next 3 months, but I'm optimistic over the next 10 years. Let's leave it there, y'all. Tesla's Q2 earnings report, short-term problems, or a serious shift in the EV market? For me, it's the former. But I'm always watching to see how things develop. If you want more videos like this, be sure to like this video and consider subscribing if you aren't already. If you have any questions, leave them in the comments or feel free to email me at askalexherrera@gmail.com. As always, thanks for watching. Until next time, take care of yourself and best of luck.